Two stocks to buy before they recover. This is a video that I've been doing a little bit more often because I'm seeing the S&P trading at all-time high, but I'm also seeing amazing setups on quality companies. They are still beaten down 20-30% over the last few months, and I think they're looking very interesting. And I think today's video is going to be amazing, especially on the second one, because it's not really talked about a lot on YouTube, and this is something that I have some long-term options on it, and I have exposure to the stock. And I think it's presenting an amazing setup, and not a lot of people are talking about it. But I think you're going to enjoy it. I think you're going to find it interesting. And if you do enjoy the video, all I'm asking is please press the like button and let me know what you think in the comments. Now, the first one, which to me is getting very interesting, after I did some research, and I'm going to show you the research that I did, and this one is FICO. FICO is still down 24.5% year to date, despite Jerome Powell announcing potential rate cuts, despite the president trying to do everything he can to lower interest rates, which is very bullish for housing. And you look at the housing stocks like the home builders, they're up 12% over the last 6 months. They've been outperforming the S&P and the NASDAQ, but FICO, it just started to move, but it hasn't really done nothing. It's still down 24.5%. So if we're going to have lower interest rates, a lot of people will be buying homes or they will be refinancing. They're going to use FICO scores to determine if they want to approve them or not approve them. So the setup here is looking very interesting. But for FICO, it's not just about their scores business, which has been growing really well. They also have like a software solutions kind of business. It's not the fastest growing one, but it's high margin recurring revenue, and they do really well with the software business. Now, something that I read on FICO, which to me was extremely interesting, and it's the whole thing about pricing, because the biggest risk with the company is because there's some scrutiny on them from the housing authorities, is what if they don't raise prices? But then I watched so many videos of the CEO. He's not worried about the Vantage score, not even a single bit. Most of those brokers have been using FICO for decades. They will likely continue using FICO. And based on what I'm saying, they will likely raise pricing a lot for many years to come. And this is what this article says. It says FICO stated that its mortgage score pricing strategy remains unchanged following the FHFA decision to implement lender choice for mortgages, which is very important. Now, this just the company cited that the rating agencies charge 8 basis points on average to rate corporate debt, which is mainly companies like Moody's, S&P Global, where they rate corporate debt. If we apply the same spread to the average US mortgage, where FICO has an edge of $375,000, the result implies a value of $300 per score. But FICO right now is charging $4.95, which is a small fraction of the cost. You have closing costs at $6,000 and many much larger costs than the FICO score, which is only $4.95. So if we apply whatever companies like Moody's are charging to rate corporate debt, if we apply it to mortgages, the FICO score would be $300. Now it's only $4.95, which really shows you the runways that FICO has in terms of growing earnings per share at a 20% plus rate for many, many years to come, potentially for the next 10 years. Now, the biggest risk remains is maybe they're going to cap prices on FICO, which they have done before because other agencies, scoring agencies, had some agreements on FICO, but after 2018 it was gone. But I don't think the government is going to try to like cap pricing on FICO because they introduced the Vantage score to increase competition. So I think they introduced the Vantage score for them not to have to cap prices on FICO. So I don't believe FICO's pricing will be capped. I think that's why the Vantage score was introduced, and the companies still have amazing metrics, return on capital, almost 40%. Amazing stuff. Net income margin, 32% net income margin. This is a very profitable business, and the company has been buying back stock like never before, especially over the last few quarters, as the CEO believes that the company is looking undervalued at $1,500 per share. And this is the biggest one that I struggled with, because when I look at the PE ratio, I'm like 42 PE. Is still high, even though it's close to the average. 42p is high. But if you take into consideration that they have 31% net income margins, if you take into consideration that their score is only $4.95, and it should be 300. And they can raise prices for the next 10 to 20 years and grow earnings per share at a 20 or 25% rate. So if they can grow at 20, 25% in earnings per share and is trading at 42 PE for a company like FICO, is this really extremely overvalued? It's not. Maybe it's not undervalued. Maybe it's close to fairly valued, but is it extremely overvalued? It is not extremely overvalued. And I used to say that FICO was overvalued, and I was against the company when I was trading at a high multiple. But if you try to understand the score dynamics, 495, and it should be 300, and how long the runways are for FICO to raise prices every single year. If they raise it by 20 or 30 cents, they can grow earnings per share 25, 30%. So this is an amazing business model, and such business model is never going to trade at like a 20 PE or 22 PE. I mean, it rarely happens. So for me, I'm seriously considering buying FICO, especially taking into consideration the potential tailwind from mortgage rates potentially, coming back. And this is something from Morningstar, where they analyze the potential earnings per share for TransUnion, Equifax, and FICO in terms of the comeback in mortgages. If we do have lower interest rates, mortgage origination will pick back up, and they put it on the bearish case scenario, mid case scenario, and the bullish case scenario for 2028. Now, if we run some numbers based on Morningstar's estimates, which is a very good analysis research firm, I like their articles very much. Now, if we take the mid-range of $50 in earnings per share, and we time it by 40 times earnings, a little bit lower than the 42 times earnings, we're getting $2,000 per share from now to 2028, so in like 2.5 years. The current price on FICO is, I believe, $1,500. So this is 33% on the upside over the next 2.5, 3 years. This is really not bad at all with a company like FICO. Now, if they take the $73, if we do have a massive comeback in mortgage origination, if we have lower interest rates, and it could happen, and we times that by 40 times earnings, this is almost $3,000 per share. And FICO right now is trading at $1,500. So this is almost 100% on the upside in the next 2 to 3 years with a company like FICO. So this is really not bad at all, as long as this sustains a 40 PE. And based on everything I'm seeing, especially the housing tailwinds from interest rates, the multiple already got cut in half from 80 times to 40 times. Betting on 25 times is a highly unlikely scenario. So that's why I'm seriously considering buying FICO. It's looking very interesting, especially after I understood the score dynamics. And I think this one is very, very interesting at this price. The second one, which is also a very interesting pick that not a lot of people are talking about, and this is Copart. Copart is down 18% over the last 6 months. This is one of the best performing stocks of all time. And it's kind of like FICO, where people always wish the stock would come down, but it pretty much never goes down. And the dips, they just keep on getting bought because it's an amazing company. And I wrote this on X, and it got a lot of attention, 341 likes. 249 saves. So I'm like, I have to talk about this stock and explain the thesis. So I said, wide moat, 20% return on invested capital, 31% net income margin, 12% earnings per share growth, $4.50 in cash per share, and no debt. And I said, what am I missing? And I got some good answers, which I'm going to talk about. But FICO pretty much runs a duopoly with another company called IIA. I believe it's called United Auto Auction. And they own 80% of the salvage auction market. So if you ever have a car and you run into an accident, hopefully it never happens to you, and your car is just so damaged beyond repair, the insurance company will total it. They will say, just take it to the junkyard. Now, those junkyards, most of them are owned by Copart, and then it would go into the auction. So Copart has an advantage because they invested in a lot of real estate. So they own those junkyards, they own the salvage yards, and this is not something that people want to have in their backyard. This is not something that you can build again. And they own the real estate to them, and they keep investing in real estate. Their competitor, IAA, is still leasing those lands. They don't actually have a real estate footprint, which gives the company a massive, massive moat over auctions in general, and it's pretty amazing. The company has a lot of tailwinds, which you would not think they're tailwinds. The first one is international expansion. So they're expanding in markets like Europe, Latin America, and Middle East, and they're buying up a lot of junkyards over there, and they're establishing a moat. Other ones is severe weather events like hurricane, floods, which we've been having more of them, unfortunately. It causes more salvage volumes to pick up, and Copart will benefit from it because they have an infrastructure to respond quickly and storage units in Florida and many different things. The last one is the rise of electric vehicles, because electric vehicles, they make repairs very expensive in terms of batteries and other things. So most of them, they declare them at a total loss, and they end up pretty much taking it to the salvage yard, which benefits Copart very much. Now, Copart itself makes money from two different ways. The first one they make money is mainly from the whole auction. So you have to pay a fee to enter the auction, and they collect fees, kind of like Disney collects fees to enter their parks. You have to pay fees to get into those auctions, and they get a lot of commissions. The second way they make money is some cars in the United States. They're actually good. Like, they're good, you could drive them, but they don't qualify as, maybe good enough for US standards. So they sell them in the Middle East, and they sell them in other countries for a massive profits. And this is the second part of the business. Now, the interesting part about Copart is they still have high insider ownership. So Willis Johnson, which he wrote Junk to Gold, an amazing book on Copart and how the process works. He still owns 8% of the company. And I believe his son-in-law, Jason Adair, he owns 5% of the company, and Jason Adair owns 3%, which I believe is the CEO. So now you have around 9% of the company owned by the insiders, which means they have skin in the game. And this is, again, pretty amazing from the company. Now, something, again, that's very interesting with the tailwinds is now we have many different things like the LiDAR sensors and automated driving systems. And most people believe that this is going to make Copart's business obsolete because drivers will not be crashing their cars as often. But I don't believe this is true. And this article explains it, that because you have all those expensive LiDAR sensors and all those things, if something happens to those cars, it's going to be so expensive to repair that a lot of the insurance companies, they will just pretty much take it to the auction. And it says this trend results in more vehicles entering Copart's auction. An approximate 1 in 5 cars is now totaled after accidents, up from 1 in 10 a decade ago. So 10 years ago, 1 out of 10 cars used to go to the auction because most of them were repairables. Now you have all those safety features and all those fancy things on the dashboard, which we all like very much, but it makes the car so expensive to repair that the insurance companies are taking them to the salvage yard, and now 1 out of 5 cars are actually going to the auction, which is a massive tailwind for a company like Copart. Now, I told you guys about the real estate footprint of Copart. They keep buying up real estate. They don't do buybacks. They don't do dividends. They just take the money and they keep widening the moat, kind of like Amazon, but they do it in a salvage yard business, and they keep buying up land, international lands. They're expanding internationally, and every single quarter, their real estate footprint increases, and they love having control over their own land, which is pretty amazing. You look at the company's cash per share, they have $4.50 in cash per share. This is a lot of cash on the balance sheet and zero debt. They're very conservative. They rarely take on any debt and have $4.50 per share in just cash. And by the way, I'm using fiscal.ai to come up with all those charts. And if you want to try it out, they give you 2 weeks of free access if you use my link down into the description. Now, I told you guys about the net income margin, 32% net income margin, very high margin like FICO, but for salvage yards, which is unheard of. The company still has good return on invested capital, 25% return on invested capital. Pretty amazing stuff. Now, here comes the final part, the tricky part, and this is a PE ratio. Because the PE ratio is trading at around 29 times earnings right now. The average is 31. It was trading at 37, 38 times not long ago. And now it's trading at 29 times earnings. And 29 times earnings looks overvalued. But because they have cash and they have no debt, you have to adjust for the $4.50 per share. So for Copart, you're not really paying $47 per share, you're paying more like $42 or $43 per share. And that would take the PE ratio down from 29 times earnings to around 26 times earnings, which could still be expensive in modern standards, but I don't believe it's too expensive for the company, given the balance sheet, given the cash position, given the real estate, given the moat, very wide moat, kind of a duopoly like Visa and MasterCard. You have IAA and you have Copart, which owns their own land. And this is pretty much where the stock kind of bottomed back in 2022 at 23, 25, 26 times earnings. So now if we adjust for cash, they would be trading where they were in the 2022 crash, which makes the company a little bit more interesting. So for the returns on Copart, they've been growing earnings per share 16%, 13%, 9%. This year they're going to grow 9.5% and then 11, 12%. Now the beautiful part about it is they're not growing earnings per share, 11, 12% due to buybacks. They're not buying back stock. All of this is 100% organic. So on Copart, I would expect the return to get back to the 11, 12% range on earnings per share. So they can grow earnings per share 11, 12%. And that's what I would expect in terms of a return around 12% per year. But I believe the return will likely be higher because if they start getting the tailwinds of international growth after that investment, the earnings per share growth could easily pick up to 13, 14, 15% every single year. And you could have the potential of a multiple expansion if the market prices it in like it was a quality stock not long ago. And it goes back to 37, 38 times. Although I would not bet on it, but then your return could be much higher than 12, 13%. So I like Copart very much relative to the overall market, especially if we have a pullback. The company will likely do extremely well. I also like FICO. Both of them look expensive, but if you do a deeper dive beyond this video and you read some articles, you'll kind of understand why they're expensive and why they're unlikely to get cheap anytime soon. And that's just my opinion on those stocks, not financial advice. I hope you enjoyed it. If you did enjoy it, please press the like button and maybe consider subscribing. So I'll talk to you in another video.